A horse-drawn buggy pulls up outside a small-town bank in Lancaster County, Pennsylvania. A young couple climbs down, dressed head to toe in plain clothes. No smartphone in his pocket, no laptop, no wallet stuffed with credit cards. This guy has never had a credit score in his life. Not a bad one, none at all. As far as every lending algorithm in America is concerned, he basically doesn't exist. And yet, a few weeks later, that same couple is standing in the middle of their own farm. Rolling green fields, a big white farmhouse, a red barn, the whole picture-perfect thing. Property value? North of $500,000. Some of these farms go for $2, $3, even $4 million. No 30-year mortgage, no loan officer, no monthly payment hanging over their heads for the rest of their lives. So how on earth does that happen? Because I promise you, the real answer is a whole lot stranger than they just paid cash. Let's start by killing the biggest myth about Amish money, because almost everything you've heard is probably wrong. The story you've likely been told goes like this. The Amish don't trust banks, so they hide cash under the mattress, and when it's time to buy a farm, Grandpa hauls out a suitcase full of $100 bills and slaps it down on the table. Great image, almost completely false. The reality is that the overwhelming majority of Amish adults have a checking account at a regular bank. Most have savings accounts too. A solid share of Amish households even carry a credit card. They just pay it off in full every single month, so they never hand over a penny of interest. And it gets better. Back in 2013, a group of Amish businessmen didn't just use a bank. They helped start one. It is called the Bank of Bird in Hand. It opened its doors in December of 2013, right in the heart of Pennsylvania Dutch country, and it was actually the first brand new bank to launch in the entire United States since 2010. Roughly 42% of the money that got it off the ground came from Amish investors. 5 of its 12 founding directors were Old Order Amish. There is even a drive-through lane built extra wide with a hitching post out front, so you can literally tie up your horse and buggy while you do your banking. So no, the Amish are not allergic to banks. That is not the secret. The real secret is something far more interesting. It's not that they refuse to use banks, it's that they refuse to carry debt. And once you understand that difference, this entire mystery starts to unravel. To understand why the Amish treat debt like a hot stove, you have to go back to the Bible, because for them, this was never a financial strategy. It's a religious conviction. There's a line in the book of Romans, chapter 13, verse 8. Owe no man anything but to love one another. Read that literally, and it becomes a rule for your whole life. Don't owe anybody, ever. There's another verse in Proverbs they take just as seriously, the idea that the borrower is servant to the lender. Translate that into plain English, and it means if you owe the bank owns you. And the Amish have spent 300 years building a way of life specifically designed so that nobody owns them. This goes all the way back to their Anabaptist roots in Europe. Those early Anabaptists were deeply suspicious of usury, which is just an old-fashioned word for charging interest on a loan. Making money off of somebody else's need was seen as a kind of sin. That belief crossed the ocean on wooden ships centuries ago, and it never really left. Now stack on top of that the value sitting at the very center of Amish life. It's a German word, Gelassenheit, and it roughly means humility, submission, letting go of your own ego and your own ambition. Debt is the enemy of every bit of that. A mortgage chains you to the outside world, to interest rates, to strangers in an office who can foreclose on your family's land. It makes you dependent. And dependence on the English world, which is what the Amish call everyone who isn't Amish, is exactly what they have organized their entire society to avoid. So when a young Amish farmer needs money, walking into a bank and signing up for 30 years of debt isn't the obvious first move. It's closer to a last resort, which leaves us with an obvious question. If not the bank, then who? Quick, but important detour, because if you take one single thing away from this video, make it this. There is no such thing as the Amish, as one giant group that all does the same thing. Think of it more like a spectrum. On the strictest end, you've got groups like the Schwarzentreuber Amish. These are the plainest of the plain. No indoor plumbing, no electricity, no linoleum on the floors, buggies without so much as a rear-view mirror. These families are the closest thing to that cash-only stereotype. They're the most likely to keep money out of banks entirely, and the most likely to quietly sell a farm to a neighbor for well under market value just to keep it in the community. Then you've got the big middle, the old order Amish, which is what most folks picture when they imagine the Amish. They'll use a local bank for the everyday stuff. They'll take a mortgage if they truly have to, but they'll move heaven and earth to pay it off fast. And on the more progressive end, especially in a place like Lancaster County, you've got New Order and business-heavy communities that are surprisingly plugged into the modern financial world. Credit cards, conventional farm loans, the whole toolkit. So when we talk about how the Amish buy farms, understand that we're really talking about a set of tools, and different families reach for different ones. But here's the wild part. No matter where you fall on that spectrum, the money almost always ends up flowing through the same handful of hidden systems, and the very first one kicks in when you're still just a kid. This is where we start building what I like to call the capital stack, because a $500,000 farm never comes from one single place. It's built in layers, and the first layer starts shockingly early in life. In most Amish families, once a kid is old enough to work, and that might mean working on the family farm, in the family furniture shop, or for an outside employer, the paycheck does not go to the kid, it goes to the parents. And in a lot of communities, that continues all the way until that child turns 21. Now, before you feel too bad for these teenagers, they usually get to keep a slice for spending money, often somewhere around 10 to 25%. But the rest, the bulk of it gets saved and increasingly invested. There are accounts of Amish fathers taking their children's earnings and funneling them into community investment funds, so the money is actually growing the entire time. One story describes a young Amish man who had built up enough through his family that he bought his first rental property at 18 years old. 18. Think about what that does over time. Amish families often have 7, 8, 9, 10 children. Every one of those kids is working from their early teens and feeding a shared family pot for the better part of a decade. That is not pocket change. That is a slow-motion capital machine humming quietly in the background of every single household. So by the time those kids are ready to start families of their own, the family already has serious resources built up, which pours directly into the next layer. And that one is all about who inherits the farm when mom and dad are finally done with it. In the English world, when you want a house or a farm, you generally head out and buy one on the open market at full price. In a lot of Amish communities, land works in a completely different way. It rarely hits the open market at all. It gets handed down. And here's a twist that catches people off guard. In many Amish families, it isn't the oldest son who inherits the family farm. It's the youngest. It's a custom called ultimogeniture, and there's a real logic to it. The older kids get help buying their own places as they grow up and move out, while the youngest stays home, works the land the longest, and eventually takes it over. Mom and dad don't move away either. They retire into a smaller addition built right onto the farmhouse, often called the grandfather house, and they stay put while the next generation runs the operation. So instead of a farm getting auctioned off to the highest bidder every generation, it stays inside the bloodline, passed down at family prices rather than market prices. That alone saves an absolute fortune. And it isn't just the land itself. When a young couple gets married, the parents step in to help set up the new household. The bride typically brings furniture, quilts, household goods, sometimes even livestock. Parents might gift or lend money toward that first farm or that first business. Nobody is starting from zero here. Everybody is starting on a foundation that older generations already poured for them. But savings and inheritance can only take you so far when farmland is selling for tens of thousands of dollars an acre. To close that gap, a lot of Amish families turned to something the outside world massively underestimated. They turned to business, and some of them got seriously, quietly rich doing it. Somewhere around the 1980s, something shifted in Amish country. As families grew and good farmland got harder and harder to come by, more and more Amish moved into business. And I don't mean cute little roadside stands. I mean serious operations, furniture workshops shipping across the country, construction crews, metal fabrication, produce farms, bakeries, storage barn builders. That famous Amish craftsmanship turned into real money, and Amish businesses are ridiculously good at surviving. Studies have found their failure rate is a tiny fraction of the rate for typical American small businesses. Some of these companies pull in millions of dollars in sales a year. There are, very quietly, Amish millionaires walking around. You'd just never know it because a guy worth a few million still dresses plain, still drives a buggy, and still lives in a farmhouse with no television. So what does a successful Amish businessman actually do with all that profit? He can't exactly go buy a yacht. The church genuinely frowns on businesses getting too big and too flashy because that pulls people toward pride and away from the community. So the money has to land somewhere humble and useful, and more often than not, it lands in land. This is where it gets genuinely fascinating. A sociologist named Conrad Kanagy over at Elizabethtown College actually dug through the property deeds in Lancaster County to measure exactly this. What he found was that between 1984 and 1995, the Amish gained a net 137 farms. He tracked something like 11,500 acres moving into Amish hands, and his later research valued the total Amish farmland in that county at close to $1 billion. Kanagy called it, and I love this phrase, a kind of ironic twist of capitalism. Amish entrepreneurs were taking the profits from their very capitalist businesses and pumping them straight back into farmland, using modern business success to protect their old-fashioned farming way of life. They were, in effect, outbidding suburban developers to keep their own kids on the land. So that's 3 layers: kids' wages, family inheritance, and business profits. But there's a 4th layer, and it might be the most Amish thing of all, because it's the reason they don't need insurance companies. Or, as we're about to see, banks. You've probably seen the image of an Amish barn raising. A barn burns down, or a family needs a new one, and one morning 100 neighbors just show up, and by sundown there's a brand new barn standing where there was nothing at all. That is not a quaint little tradition staged for the tourists. That is the entire Amish economic philosophy, made physical. The Amish, for the most part, refuse to buy commercial insurance. No health insurance, no homeowners insurance, no crop insurance from the big companies. Why? Because leaning on a faceless corporation to catch you when you fall is the exact opposite of leaning on your community, and the community is the whole point. So instead, they built their own systems. At the simplest level, when a family gets slammed with a massive hospital bill, or a fire, or a storm, the deacon of the church, who handles the money side of things, quietly passes the word around. Members give what they can. It's honestly a pass-the-hat operation, except this hat holds tens of thousands of dollars. Then there are the more organized versions, with plain-spoken names like Amish Aid. Whole regions run structured programs where every member pays in, and when disaster strikes, a group of neutral church members from different districts actually goes out, estimates the damage, and pays the affected family a big chunk of the loss. For medical costs, communities run their own health-sharing plans, sometimes for around $90 to $110 a month per member, and because they pay hospitals in cash, they negotiate serious discounts on the bill. Now think about what that does to a family's finances. They aren't bleeding hundreds or thousands of dollars a month to insurance companies. That's money that stays in the family, stays in the community, and quietly stacks up toward the next farm. But mutual aid does something even bigger than shave off insurance premiums. It became the foundation for the most surprising piece of this entire story. The Amish didn't just replace the insurance company, they replaced the bank. This is the part almost nobody outside the community knows about, and it's the real engine behind those cash farm purchases. Scattered across Amish country, there are these community lending funds. Think of them as tiny, member-owned banks that operate almost entirely inside the Amish world. And they are not small. Take one of the biggest, based in Pennsylvania, called the Old Order Amish Helping Program. Here's how the machine works. Amish members who have money to spare invest it into the fund, a bit like putting money into a savings account. The fund then takes all that pooled money and lends it back out to younger or needier members who are trying to buy a farm. The loan is secured by the farmland itself. It gets paid back over about 20 years with a balloon payment due around year 10, and the interest rate is deliberately tiny. In one of its filings, the rate on those farm loans was just 2.8%. The investors who put money in earned somewhere between roughly 2.4 and 4% for their trouble. Everybody wins, and the money never leaves the community. Now, here comes the number that made my jaw drop. According to its own tax filing, that single fund reported total assets of over $379 million. $379 million. From a religious community that supposedly stuffs cash under the mattress and runs from modern finance. They quietly built a farm lending operation worth about $250 million, and that's just one of them. Over in Indiana, there's the Amish Mutual Mortgage Fund, a church-controlled organization where Old Order Amish members invest money that then gets channeled to others who need to borrow for real estate. In Ohio, there's the Geauga Amish Loan Fund, which exists specifically to help Amish members buy land and build on it. There's even an Anabaptist financial cooperative called Everence that plays in this same world. And on top of the formal funds, there's the informal version. A successful Amish businessman with cash to spare will often just personally hold the mortgage for a younger family buying a farm. He becomes the bank, and he knows full well he'll get paid back, because in a community this tight, defaulting on a loan from a fellow church member isn't just a financial problem, it's a moral one. The whole community knows. The bishop gets involved. The shame is very real. So repayment rates inside these systems are basically flawless, which is exactly why the interest can stay so low in the first place. If you're enjoying this deep dive into how an entire society quietly rewired money, do me a quick favor and hit that subscribe button. I dig into hidden stuff like this every single week. Alright, now let's talk about how a deal like this actually closes, because that part isn't what you'd expect either. Time to bust another myth. Even when an Amish family buys a farm with community money or family money, it is usually not two guys shaking hands and passing a paper bag across a kitchen table. These are real, legal, recorded transactions. There's still a title search to make sure the seller actually owns the land free and clear. There's usually a title company or an attorney involved. The deed gets officially recorded down at the county courthouse, exactly like any other property sale in America. When there's a loan from a community fund or a private lender, there's a genuine promissory note and a real mortgage recorded against the property. It's all legitimate, and it's all above board. The difference is simply who's holding the paper. Instead of a giant national bank, the lender might be a neighbor, a church fund, or the seller himself. That last one is huge. A common setup is seller financing, sometimes called a land contract, where the person selling the farm basically becomes the bank. The buyer makes payments directly to the seller over time, and the seller holds on to the legal title until it's all paid off. No outside lender required at all. And the bishop and the deacon aren't only spiritual leaders in all of this. They act as financial referees. If there's a business dispute, the bishop might step in to settle it. A church can even vouch for a member to an outside bank, essentially promising the lender that if something goes sideways, the community itself will make it right. Try getting that kind of backing on your next home loan. So when people say the Amish buy farms in cash, what they usually mean is this: there's no 30-year bank mortgage strangling the family for decades. The actual money can come from a dozen quiet sources stitched together. And when you add all of those sources up, that $500,000 farm suddenly starts to look very, very possible. Let's actually do the math, because this is where the whole capital stack finally clicks together. Farmland in Lancaster County is not cheap anymore, not even close. Prime ground there has reportedly hit $40,000 to $50,000 an acre. According to a local agricultural consultant named Jed Monkovich, those are real prices on the best land, and even the county-wide average sat above $21,000 an acre as of the 2022 agricultural census. So a fairly modest 100-acre farm can run straight into the millions. This is land so expensive that farming it barely pencils out on paper. So how does a young couple pull together $500,000, or $1 million, or sometimes even more? They stack it. Watch how the layers combine. Maybe the family sells an older farm they've owned for decades, one that has quadrupled in value, and that alone throws off a giant chunk of cash. Add in the savings the parents built up, including years of the kids' pooled paychecks. Add a gift or a low-interest loan from mom and dad. Add a loan from one of those community funds at 2.8% or a private mortgage from a wealthier neighbor. Add the profits from the family furniture business or the construction crew. And in Lancaster especially, if there's still a gap left over, yes, sometimes they'll top it off with a conventional bank mortgage that they then attack and pay down at lightning speed. Stack all of that together, and the down payment isn't really a down payment anymore. It's most of the purchase price, or all of it. That's the trick right there. It was never one magic source of money. It's 5 or 6 perfectly ordinary sources, layered on top of each other by a community that's been saving and sharing and reinvesting for generations. But here's the catch. In places like Lancaster, even all of that stacking eventually isn't enough. When land climbs to 50 grand an acre, something has to give. And what gives is geography. This is the pressure valve that keeps the entire system alive. When Amish families can't afford farmland in their home county, they don't give up farming. They pack up and go find cheaper land somewhere else. And the math on this move is beautiful in its simplicity. You sell one insanely expensive Lancaster farm, and with the proceeds, you can go buy 2, 3, sometimes even 4 farms in a state where land costs a fraction of the price. You don't just break even, you multiply. Take a real example. A young Amish man named Amos Stoltzfus, 29 years old, left Leola, Pennsylvania, and together with his father bought a 158-acre farm across the state line near Emmitsburg, Maryland. His own share came out to 53 acres, and he paid roughly $13,000 an acre. Compare that to $40,000 or $50,000 an acre back home. That same young man had been running a woodworking business, building rocking chairs, before making the leap. In that same community, a 24-year-old named Henry Lapp watched his family buy a 45-acre farm near Emmitsburg after leaving bird-in-hand Pennsylvania. Young families, priced out of home, finding solid footing somewhere brand new. And this is not just a handful of families here and there. This is a full-blown migration, and the numbers are honestly staggering. According to the Young Center for Anabaptist and Pietist Studies at Elizabethtown College, the Amish population in New York State grew by 371% between the years 2000 and 2020. Kentucky grew 180%, Missouri 165%, Minnesota well over 200%. Maryland has been booming since the pandemic. The Amish are quietly spreading across rural America, one affordable farm at a time. They aren't only chasing cheap dirt, though, because the way they move might just be the smartest part of this entire operation. When the Amish decide to settle a brand new area, they don't just scatter out randomly and hope for the best. They plan it. Before a big move, groups will send out what are basically land scouts, sometimes called land parties, to research an area, check the soil, meet the locals, and negotiate on farms. And there's a rule the organizers of these new settlements repeat over and over again. Culture first, real estate second. Meaning, it does not matter how cheap and gorgeous the land is if you can't build a real community around it. A lot of planned settlements won't even move forward unless they've got a minimum number of committed families, often something like 5 to 10, ready to relocate together at the same time. Because you simply can't run a church district, a schoolhouse, or a barn raising with 2 families. You need critical mass. There are even real estate agents who specialize in exactly this, some of them Amish themselves, who understand precisely what these families need and help coordinate multiple farm purchases all at once. Sometimes, several related families buy a whole cluster of neighboring farms in a single swoop, rebuilding an entire community in a new state almost overnight. So picture the whole thing. A group of families in Pennsylvania, feeling the squeeze of land at $50,000 an acre, pool their knowledge, send scouts down to Kentucky or up to New York, find a cluster of farms at 1/10 of the price, sell their pricey home farms, and move as one unit, community fully intact. They don't just survive the move, they come out the other side owning more land with less debt than they had when they started. It's honestly kind of genius. So step back and look at the whole machine for a second, because once you see it, you really can't unsee it. The Amish took every single function that the rest of us outsourced to giant institutions, and they pulled it back in-house. We use insurance companies. They use their neighbors. We use banks for mortgages. They built their own lending funds. We use credit scores and loan officers and 30 years of debt. They use family savings, pooled wages, inheritance, business profits, and low-interest loans from people who sit next to them in church. It's a closed loop. The money the community earns gets saved within the community, invested within the community, lent within the community, and used to buy land that then stays within the community. Almost nothing leaks out to Wall Street. Almost nothing gets bled away in interest payments to strangers. And because everyone knows everyone, and because your reputation is worth more than any amount of money, the whole thing runs on a level of trust that a normal bank could only dream about. Is it perfect? Of course not. Families still hit hard times. Some still take on bank debt. Land is getting expensive, even in the new settlements. And the pressure to keep migrating never fully goes away. But as a system for helping ordinary people buy extraordinary amounts of land without drowning in debt, it flat out works, and it has been working for centuries. There's something almost radical about it when you really sit with it. In a world that runs entirely on borrowing, a community that quietly refuses to owe anyone a dime has managed to buy up huge chunks of rural America, one cash farm at a time. So the next time you drive past an Amish farm and see that spotless barn and those endless green fields, remember what you're actually looking at. Not just a farm, a financial system, one built on discipline, community, and a 300-year refusal to owe the bank a single dollar. They didn't beat the system. They quietly built a better one for themselves and then bought the farm next door with it. If you learned something today, tap that like button. It genuinely helps the channel more than you'd think. Subscribe if you want more deep dives into the hidden ways the world actually works. And I'm honestly curious, would you trade your credit cards and your mortgage for a system like this if it meant never owing a bank again? Drop your answer down in the comments. I read them. Thanks for watching, and I'll catch you in the next one.